This conference will now be recorded.
Hi, I'm Patrick Reed from the Adamas Principle. We have got a very special US edition tonight, and you know, I just think I love the US for lots of reasons. I used to live in LA, and I've spent many a time exploring the West Coast. I've been to New York, and I just think the US is the heartbeat of many of the Western world for me. It's got a lot of problems. Don't get me wrong. We all have.
Mm.
I've got a few problems myself, but the US is a great country. And this webinar uh, is not solely going out on the US channels. Just clear that up. It's going out worldwide because it's on
Exactly.
our LinkedIn feeds. So just well, I thought I'd do a US special, and I just thought I'd talk about a subject very close to Beat's heart and myself, and it's about the FOMC. It's about where they are in rhetoric, positioning, and what rates are doing, what's the dollar doing, and why are we all banging on about it? What's the macro picture like? And why are we all mentioning this? If you're retail and you're dipping in for the first time, stick around. It's I'm very, very privileged to have one of the best macro traders there is, and that is Beat. Hello, Beat.
Hi, Patrick. Thanks very much for the flowers. How are you doing?
I'm very well. I'm very well. It's been, I we like to chew cud, we like to talk shop, we like to try and get the teeth of the story. And for me, there's nothing more interesting than Jay Powell at the moment, and and what the Feds, what their rhetoric is, how they positioned, what the new US macro picture is. And I just want to, before I sort of open it up, I just want to, and I do this quite a lot. I used to do it every month for the US macro picture, look at the fundamentals, to look at the temperature. And I'm doing it, but I'm also doing it. I do a little timeline. It doesn't have to be perfect. I recommend anyone to do it as well in the rhetoric. I do a little timeline on the rates as well. I have a lazy eye on the 10-year curve on debt in the US, but it just kind of sense checks and puts a good framework for the conversation. So here we go. So the US special, as we are, everything really started in October when the US macro picture was largely pristine. Numbers were blistering. GDP was up, unemployment amazing, wages great, CPI amazing, city supply still all right, and ISM's touched the 60s, whatever it was, really good. OIS pretty good, pricing in 3, maybe 2 to 3. Some were saying 4, but it was more like 2 to 3. ED futures were looking rosy, and not a cloud on the horizon.
Yeah.
The dot plot needed a bit of a revision because we were talking about that at the time, I think. And now it's all changed. Now, I just want to reiterate the US data has not really changed materially. Wages are still pretty firm, materially on the increase. CPI's obviously the headlines dropped because of oil. The core still sticking around 2%, and the headlines not far off. GDP around 3.4, not tanking, you know. I would say obviously potentially softer ISMs, but let's wait for the hard data to come through. And we've all been saying a bit of a timeline as from October, well below neutral was the first thing that Jay Powell said. Then it was just below neutral. Then we were talking about being patient, then data dependent. OIS priced out a hike this year. ED futures priced in a cut. China creaking, PMI sub 50. Now, interestingly, we've been talking about a Fed put potentially. I've been talking about a Fed put, but in stealth mode. We still, because of the shutdown in the US, we're still waiting for some nice hard data. I think I really like that last thing that you've posted, Beat, about a collar, not a put, a collar. And in my basic knowledge, I was thinking like somebody's collaring me like this, but in my basic knowledge, that means a kind of range play. Is that right? Is that your take? What do you think about all of that, mate?
To be honest, I will come to what I think on the second part. The first part would be the story about put or collar, which I sort of posted, which was an article in Bloomberg that I found interesting. So reality is that someone had the idea that the Fed would be sort of neutral slash dovish, if you want, with the Fed put if equities are under pressure. Should the data be okay and equities starting to rally, then the Fed is bringing back the rate hike, meaning limiting the upside of stocks. So it's almost like, in an option type of discussion, that would mean you selling volatility. The reality is what he's doing is it can't go down, can't go up. As soon as we go down too much, they would be dovish. As soon as we start to go up, strongly, they will become hawkish.
Yeah.
So now I come back to what we discussed in September, October, November, December, every month, or when we started to get that feel that the Fed is going to be less hawkish. We both did agree back then that the Powell is very pragmatic. And you sent me a link once, back end of last year, an interview. I think it was a 1 hour interview with Powell, where he was interviewed. Can't remember, one of the other Fed members. It was like a regional Fed event or whatever. They talked about gold and the world and blah blah blah, everything. And that was a very insightful interview with Powell that sort of showed a little bit of how he thinks, what he thinks, how he thinks about stuff, what he thinks the Fed should be doing, and so on and so forth. And that's why I was probably, even now, still a little bit on the pragmatic side rather than the dovish side. Why is, they have actually talked about watching data already in December meeting. They talked about it in the November meeting. So really, for those that actually follow the Fed, it shouldn't actually be new. The Fed is currently doing exactly what they said they will be doing, which is they told us what the risks are, global growth. They told us trade war is a risk, and they told us that the tax cuts that are sort of fizzling out in itself will create a little bit of a more restrictive policy. So really now you have more GDP downgrades around the world. The Fed is sitting there looking at its data and says, you know what, our data are still okay, but will they? Right? And if they really would be honest, the Fed, which is probably no secret, they don't know. And they can't know. Is the sort of slowdown that we see around the world actually knocking on the US door, which the Fed has to assume it will. Now, do we only get somewhat, weaker data, which is just a sort of consolidation rather than a turn, or will it become something more meaningful? I don't think they know. How could they? So the only really prudent thing to do was to step back. The market, as we both agreed, the market has already been at zero hikes for 2019 for quite a while, when they took down the dot plot in December from 3 to 2 hikes. You go from more or less 2 hikes to 0, or let's say, pause, or whatever you want to call it. Someone wrote, it's been the biggest U-turn in 30 years history of the Fed, or for the last years, right? And to that extent, I do agree that the the speed, or let's say, I did say it when I wrote or was blogging about it, that I don't think I remember the Fed or any developed market central bank to actually turn from hawkish to, neutral, let's say, not dovish, without its data actually turning, right? So it's quite remarkable. That's why we came up, with the idea that, as a cynical trader, you always look for another reason than just the obvious one. Well, we mentioned China, right?
Yeah.
So has the Fed more insight into what's going on in China? They for sure will have, because the Fed is talking to the large corporations. I'm sure that the Federal Reserve members speak to every CEO from any large cap in the US. They definitely have a bigger understanding on how true that slowdown is, far more than we do. Again, it's only time will tell what it was. So the cynic in me says they actually done that because they are indeed worried about China, but they themselves will not have an idea what the PBOC is going to do, whether the PBOC manages to really steer that into a soft landing rather than a hard landing. If I read about the PBOC or China at the moment, there seems to be no willingness to throw the kitchen sink at it, none whatsoever. So that means they do these little, they're going to do another RRR cut at some point. Next week, we have another round of trade talks. So the US delegation travels to China. The deputy prime minister will be part of it as well. So there's still some hope of a trade deal. But all in all, I think if we just try to, be not as cynical as we usually are, I personally think it makes a lot of sense for the Fed just to at least go, let's wait and see. There's definitely no rush to hike. CPI is under control. There's no risk whatsoever that CPI is going to gain past 2%. And you know what? Back end of or in Q3, I think it was, Powell told us in one of the meetings that the CPI is going to temporarily overshoot 2% due to the oil before oil sort of turned back down. But the Fed didn't expect that there was any follow through on the upside, and he was right. So we had this blip above 2%. Now it's kind of settling there or thereabout. So what's going to be interesting from here on is to watch the Fed speakers. Bullard himself, obviously, tough, but he's now a voter this year. He talked about he could see GDP actually going as low as 2%. So there's a few Fed governors or voting members now still pretty much actually more dovish than the actual Federal Reserve meeting was. But then again, those were all the super doves before. So they just feel like they have to, they're now finally, their voices are getting heard. So I would not overly pay attention still to people like Bullard or some of the very dovish members, because they now just feel like they're in the driving seat. So they're going to drum, the noise about being dovish. So I just personally think it would be wrong to walk away and say the Fed is dovish and we should sell dollar. And let's face it, the dollar tried to sell off for about 2 hours after the Fed, and that was it. Now, the dollar hasn't rallied for its own reason. We know why it rallied, because the data in the Eurozone is even weaker. New Italian sort of hiccups coming up, with 10-year BTPs moving above 3% again for the first time on Friday. So then we have the RBA turning dovish. So we had the Aussie selling off. So suddenly, the dollar rallies again, similar to last year or the back end of last year, by default.
Yeah.
But you just cannot sell dollars against the risk pairs, Aussie, Canada, because everything is very fragile, in my opinion. I'm a bit disappointed in FX, the back end of, or the second half of last week. We had the Dow coming off around, a few hundred points, and FX just didn't want to know really, which is a bit disappointing. So really, like you said, we have to indeed do the same what the Fed is doing, which is watching the hardcore data. And only then can we start to actually see what the truth is. I still do not believe in the Fed put. and definitely not in a Fed put that is locked somewhere at 25,000 for the Dow. We've been down what to 22,000 in December. So if people just start buying these levels because they think the Fed put is back, I think they will make a very big mistake. But again, only if stocks start to really come off, and we then watch what the Fed is doing, whether they are doing something. Only then do we actually know what really happened at the Fed meeting. We can't tell, and we can't tell for a while. And so, but the reason we talk about it today is, I put, as you know, that article in LinkedIn, and like it created a lot more discussions than any article usually does give. So that shows the market is completely split on what the Fed has done, which means there is confusion in the market. It probably explains the lack of volatility. No one kind of knows what it should be, what it was. Should we buy? Should we sell? And maybe, to be honest, high five to Powell. Happy days. I don't think the Fed is unhappy about low volatility at this point in time. So they achieved something, whether by accident or by that he really meant it to happen. We don't know. But I think what I've seen in the past many years, we saw it on the Greenspan, but even more so on the Bernanke and on the Yellen. Usually it was the market that done these stories about the Fed and trying to sort of say what the Fed is doing. It wasn't the Fed, so it's not necessarily a miscommunication by the Fed. It's what the market commentators say, what the market, what economists write about it, and then the whole market is running one way because there's a common story coming out. The story is not from the Fed. Powell told us, actually, honestly, since last year, what this is about. Yes, the speed from December to January, I admit, was a bit fast, from going everything is all right to pause. But you know what, if you look at the downgrade of GDP, even though I still think the Germans are a bit aggressive, taking 2019 GDP down to 1% from 1.8, but that has happened, early 2019, they revised the GDP almost in half, so maybe the slowdown has accelerated as well in a speed that is unusual, and that has led the Fed to just have to do the same, which is maybe more prudent than just panic, or it definitely didn't make any sense for them to sound hawkish at all while the whole world is revising growth down. I mean, they would, some people say, oh, the Fed is losing credibility. In my eyes, the Fed would have lost credibility if they would think they're an island and the Fed is still drumming the whole while everyone else is downgrading growth. So I personally, I would have thought that would have been far more stupid than just standing aside. So I'm still more in the camp of, but don't get me wrong, from pause, if the data starts to turn down, they go dovish, no doubt about it. But I don't think it's a preset course. I don't think the Fed is already thinking about we're gonna cut rates in March or we're gonna cut rates in May or June. No, not at all. I don't think so. But if the data demands it, they will do whatever they have to do, right? And against all the comments again that were on the post, they talked about the Fed this, the Fed that. Reality is the Fed is about the only central bank out there that has managed to regain some bullets, while none of the other have. I mean, let's talk about ECB, right? They screwed up completely with their single mandate around CPI, right? If they didn't have a single mandate, if they had a dual mandate like the Fed, they could have hiked rates in the mid of last year. And at least then they have something to cut. Now that numbers turn bad, Italy pokes up, God knows what's going to happen in France at some point in time. We talked about Europe in European election, parliament election in May, which is going to be a big mess. So Europe has its work cut out for this year, I can tell you that. And we haven't even mentioned Brexit. So I think the Fed is in an absolute sweet spot. They can actually, just react. Okay, if things turn down, you go dovish. things go really bad, we cut. So I think we shouldn't, slam them too much for what they've done. I actually personally think it was a brave move, and then I applaud him for that. I really do.
Fantastic. I mean, that's, there are lots of stuff there I'm thinking of, and I've stopped as a trader. I stopped trying to think this has to happen or that has to happen, and what they're doing is wrong or what they're doing is right. What I try and do is just work out the probabilities as you do, and I try and put my own bias, my own political, and my own basic economic bias to one side. And for me, the stuff that I'm considering on my considerations are the shock and the speed of the rhetoric change without any significant domestic data changing.
Yeah.
And that can be quite worrying. It's also quite a smart move if you can catch it by verbal, really. And if it is a global slowdown, massive worry that we haven't realized. I mean, we see China's PMI sub 50, but we know that before that there was the Apple story citing a miss on iPhones, citing China. Then the Caterpillar story didn't help, as you know. You told me about that. And has the Fed caught it slightly for a bit of verbal before that? Because let's face it, the data in the US hasn't really tanked.
Yeah.
So that's a smart move. Very, well done.
I was just thinking now when you were talking. I was just thinking, having had the RBA this week, just put the foot on the brakes, following a lot of other central banks. Who knows if suddenly the market was, if the Fed, let's say the Fed would have stayed hawkish, not like hawkish, but just not done what they've done. I wonder if the Dow wouldn't be maybe 1,000 or 2,000 points lower now. Because I would actually have thought that, suddenly the same people that blame the Fed now for what they've done would be the same people that would cry, oh, the Fed is behind the, look at it, they're hawkish and the rest is dovish. Oh, the Dow is selling off. There would be exactly the same people who would again say the Fed is wrong. So what you just said now, I think, might actually just hit the nail on the head, which is maybe they were just like that little step ahead of actually already containing, not as in not letting equity markets come off. I still think, from listening to Powell last year on some of his semi-private views, he thinks the stock market is very highly valued. So he has no problem if the stock market would grind lower. I think the biggest worry the Fed has is not the absolute level. The only worry the Fed has is, they know it's sort of overvalued, and the worry is that it suddenly drops a lot very quickly.
Disorderly kind of drop.
Yeah, the Fed has no, I don't think if you would tell Powell, what, the Dow is going to go down to 20,000 in the next 18 months, he would go like, yeah, he would have no problem. Orderly move, everything just deflates a little bit. But the worry is that it goes down 5,000 points in a hurry.
Yeah.
And that's where I personally think, again, we can't answer that tonight. That's why I personally think it's not a put as in a put. It's actually just moderation, as in trying to make sure things, as much as they can try to control it, which they never will be able to, because you can't control an unwind. But he was a step ahead. And that's why I think, like I said, the same people who would talk about the Fed being behind the curve if they were hawkish, in the last meeting, as the only central bank in the world. And the Dow would probably be lower. Equities would probably be lower exactly for that reason. But, I'm like you. I have my views. I stepped aside for a day or two after the Fed just to regroup, see whether my views are wrong, whether they could be right. And at the end of the day, our job is just, like you said, probabilities, right? Let's see how far it rallies. Does it still look big, or does it start to look tired? Have we just sort of changed, the levels, but the underlying story is correct? And now we reset everything, and now we start again. And I think that's probably the easier part than trying to, because no one will be able to give us the answer, what the Fed actually really thinks or why they really done it. And only data or a move in the equity market will actually tell us then, what it was. And so we will only know in time. We might sit here in 3 or 4 months' time and say, that was it. But I don't think we can say that in the next few weeks. We will not know what that was all about.
I think the interesting play for me in this whole thing was the curve, and the way the curve was telling us something way before mainstream media.
Correct.
And actually before the Fed, because that was around the dots, which needed a real look at, a revised look at lower. And the Eurodollar futures were the first, and they often are. Then OIS, started to reprice properly. And then we were saying, I remember we had that chat, we were like, okay, what's going on? And it's interesting that the curve got repriced before mainstream media, and then the dollar started to follow suit. But all along, I mean, all the domestic data was still riding high, and to be frank, it hasn't really tanked since then. So that to me suggests global worries, not internal.
Yeah, no, absolutely. And you know what? The reason why the dollar doesn't tank, if the market is right in that assessment that it's a global worry, then the dollar is going to be bid. The dollar is never, except against the yen, it should come off. But against the rest, the dollar will never come off when we're worried about global growth. It will not, right? So,
well, it could go on a tear because of risk-off rally, couldn't it?
Right? And look at where the euro is, and we talk about a dovish Fed, and the euro is just, not that far off the kind of, recent lows, really, right? So we're striking distance of the recent lows. Actually, it looks like sick, like a dog down here.
130 now,
And so really, for those that wanted to sell the dollar on the Fed, and again, like you said, the interest rate market has foregone the Fed for quite a few months. Really, the market, the dollar, doesn't really have to do anything on top of what the Fed said, because the Fed only just caught up with what the market has already priced. So there's no adjustment needed, right? And the ECB has gone dovish as well at the same time. So like something I talk about a lot is we have hardly any divergence built or new divergence between the Fed and the ECB. So I don't even think the euro will go down a lot unless it's for euro reason, as in even worse data, political issues. But let's say if everything stays as it is, you don't have big problem in Italy or anywhere else in Europe, maybe the range is just 112, 115 or 112, 116 for the next 6 months. Because I just cannot see, outside of political issues in Europe, that the euro has any move in it at all. Because why? The ECB is more or less set. The Fed at the moment is pretty much set. So for that to change, the Fed has to actually go from pause to dovish, or the ECB has to, start to, I don't know what they actually could do other than talk about TLTROs or delay in. So far, actually, we haven't had a delay in the first hike yet from the ECB, but that is probably next. That's probably when the euro gets a little further dip. But I continue to focus on in crosses. I continue to focus on potential risk off for all the reasons what we talked about the last few months. I don't see a trade in euro dollar. Yeah, to be honest, if it rallies to 114, I sell it. And when it comes back to 112.5, I buy it back. But I don't see a directional trade in euro dollar. But I still see a directional trade in euro yen. I still see a directional trade in dollar yen, even though it's gone very, very boring again. It reminds me, and that's maybe something I want to say. why we shouldn't be too casual about this. It reminds me first half of December. You remember the yen crosses started to crack, dollar yen did. Suddenly from mid-December, boom, dollar yen catch up, the whole thing got a little bit of momentum. It smells a little bit like that, because dollar yen looks like just a brick wall above 110, even though it's not much lower, it's 109.70. But it's just gut feel that I think it's not far away from rolling over, and then taking the crosses with it. Maybe it's wishful thinking as well, but it's never wrong to have a little bit of wishful thinking.
Yeah, I've got dollar yen up actually. Interesting. I'm sort of seeing it's really knocking on the door of that 110 big fig. It's I'm in my futures days with 12 screens and lots of shouting. I would fancy buying this break if it breaks up, but my macro side to me tells me it's still probably, as you said, the easiest dollar to sell. So I'm a bit torn, but it is trying to have a go. I mean, look at the amount of times. This is the daily. I mean, I've got the chart up. It's really trying its best. I mean, it has failed again, but you see around here, if it still stays up near the high, it might have another go up there.
To be honest, personally, I think it's all the Japanese exporters selling above 110.
After the knockout.
Yeah. Obviously, we don't know any sort of volumes, but we have a fiscal year end in end of March in Japan. So we have about 1.5 months left for all these sort of hedges to fall into place. The exporters have lost hedges with this 105 barrier knockout on the flash crash night. And to me, it just kind of, and you know what? It probably shows in euro yen as well, because again, there we have the same scenario that we had in November, December, where even when we had the 500-point rally in the Dow and Aussie yen went mental and Canada yen went mental, euro yen couldn't rally, right? So that shows me these both the biggest two pairs in the yen, the dollar yen and the euro yen, are just not artificially held, but there's a lot of supply there. And I really honestly think, if risk on that night was bid after the Fed or later in the week, dollar yen should have had a chance to go 110.50, 111, or euro yen should have hit, into the 126 handle or whatever, but it just couldn't do it. So as much as I agree with you, keeps on trying 110, but how, have you ever managed to be like 2 or 3 hours above 110? I don't think so. Went like 510, boom, 90.95. So that's just something. I just think, it's boring. I'm sure.
You think corporates are selling dollar yen around 110?
Yeah, I think so. I really do.
Yeah.
They would probably dream of selling it at 111, but I don't think we get there. So that's why I'm just core short. To be honest, I'm not limit short. I would sell more 1050, 1080. Same for euro yen. I'm just small core short. I didn't sell the highs. Why? Because that was the 48-hour window that I stepped back. So when we had this big rally in risk, not actually on FOMC day, but on Thursday, Friday after that, Canada yen rallied a lot, Aussie yen rallied a lot, euro yen started to go creep higher. That was just a moment where I had to reassess my views. I couldn't be ignorant about what the Fed, or let's say, as something you often say, it doesn't matter whether you're right at the end or not, but you have to respect the market. And at that window, I respected the market because I could see that the market could take it as dovish, as a kind of caving in on the pressure on the Dow, and that stocks just rally and risk rallies for like 2, 3, 4 weeks. We could have had the trade news at the same time. So I just, even though we went in Aussie yen, we went exactly to the pip to my sell level, 79.70. I didn't sell any. Why? Exactly the same. We were in the 48 hours that I could see that Aussie yen could go 82 if risk rallies another 2, 3, 4 weeks. So I couldn't really, in that 48 hours, just to commit to the old views while I have to reassess the new news. And that's something I speak with my students about, you do as well, that
Mm.
the moment you have new news, you just have to quickly step aside, reassess the new news. How does it fit versus your picture? You want to stick your picture, or do you actually have to adjust your picture? And so out of not being ignorant and enough respect from the market, I just stepped aside, and now after all that happened with the RBA, my confidence came roaring back rather quickly, that I think the risk bear view is still the one I really want to trade. And so I'm small short dollar yen, small short euro yen, trying to get back into some of the others, Aussie yen, Canada yen. I still think those are the trades that are the ones that will matter in the next 1 to 2 months. Euro dollar, give or take, whether it goes 112.50 or 114.50, I don't know. And I don't think anyone really knows or cares. The one thing I do, I blogged about it early last week or mid last week, keep that eye on BTPs.
Yeah.
We
600, isn't it?
Yeah, so we've been down at 255 10-year BTP on the 31st of Jan. We hit 3%, above 3% on Friday. So that's quite a turn. That's on the back of the minus 0.2 GDP and the weak PMI and the market knowing that Italy has 2 trillion debts, right? So there's a bit of a worry coming back to that all the growth data that Italy used in its budget are probably not going to happen. So it makes the whole situation look worse. So keep an eye on that. If we keep pushing above 3% and stay above 3%, you saw Euro Swiss is now back down to 113.20, which was up at 114.50 earlier last week or the week before. And Euro Swiss is really only reacting to Euro crisis. It doesn't care much about US stocks these days, but it doesn't like pressure in the Eurozone. And you know what? The weekend news in France, horrible, right? Some more very negative press in France about the Yellow Vest. So this whole Europe, and then you throw Brexit in it as well. And our dear Tusk with his comments, and it's going to all be a bit interesting.
He's an old charmer, isn't he?
He is indeed. Exactly what you would expect from a high-ranking politician.
Yeah. That's brilliant. The only thing I'll say, B, which is I don't want to spoil the risk bear party, but the thing that's annoying me a lot is the market does not, it still has a taste for risk. And I just think, this is the whole idea of, is it a part, is it not? I think the market would like to believe the Fed has got its back.
Yeah,
and
it does.
If it does, if it continues to do so, it's going to be very difficult for risk bears, because even though if you scientifically look, the rhetoric change was quick, right? But it was pragmatic, and quite frankly, it was needed because of the global slowdown worries. And the Fed was the first. The FT I blogged about. There was a guy Arian talking about air cover, and that's really cute. I mean, it's really good of him to say that. The Fed took the first decision, and everyone ducked for cover. To go underneath, to get and I think it, as you say, it was a bold move, a brave move. But I guess that's the only thing. And if the market really wants to believe this Fed put, whatever, let's not call it a Fed put. Let's just say the market's got, the Fed's got its back. Then just going to be a really difficult trade, isn't it?
To be honest, I would say the following. On Fed Day, the Dow was rallying from 24,580 to 25,108. We now, where are we? 120. We are at 25,117. We briefly went down to what 24,880 on Friday. So what I often do is I do write down big days on where prices were, because chart is one thing, as in trend line, FIBO, blah 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 blah. But what is very powerful in trading is to remember where the levels were on the actual day. So for me, I'm watching, let's say, 25,100. Once it's below, in my eyes, we are in that territory on that famous FOMC day. And in my brain, I have 24,580. Should I see the Dow break there? That just, to me, would be a signal of, you know what, we basically still now, we are around the, where we closed on Fed day. So the market, yes, it's holding in, but it's kind of not, either it doesn't have the power or it doesn't trust it to push it, or actually we do have still big sellers into the rallies. I don't know. To be honest, I'm not an equity expert, but what I am is a price action expert. And so that's how I watch the stock market from here on. Is really, we got up to, what was the high? The high was around 25,450. So those are more or less the three levels I watch. So 25,450 was the high in this Fed miraculous turnaround.
Yeah.
25,580 is where the whole thing started on Fed day. So to me, those are the cornerstones of equities. So if you break, let's say 25,500, then I'm probably edging towards what you just said. The market is trying to have another go, so I will probably back off a little bit. What happens in risk effect?
Yeah.
If we break 24,550, I go like, okay, that didn't really work, and then I would expect some real pain coming in. Because let's be honest, if this is not going to rally soon, and that's my honest belief about any, whether it be gold, euro, whatever it is, if something rallied on news and then it just stalls, and at some point now, and I think this decision has to come within days, where we either make progress on the top side or the whole thing is going to fall apart. And once it starts to fall, then everyone who had this hope of that rally will have to sell. So I'm not saying it's happening, but that is what I will watch next week. Is can equities, because the whole decision in effect, in my eyes, is going to come from equities now. So either this rally is going to fail, or it's going to power ahead. And because you see how lethargic FX is anyway. So the FX market seems to want to wait from the actual risk market, the equity market, which way we are going to go, and that's what I will watch. So if we not rally, if we at this level in 3 days' time, it's going to crater. That's what I personally think, because I think it has to show its mettle now, and if it doesn't, then what makes it harder is the trade talks Tuesday, Wednesday. The market might be just staying here.
Could be another window dressing, and then factor them out, and you start selling to the favored
exactly.
value. Yeah.
But to be honest, I think the market just demands a lot from us in terms of flexibility, adjusting. I think even hit and run trading, which I usually do a lot of, doesn't really work, because the market doesn't trade. The market either grinds a bit lower or grinds a bit higher. It's not like, it's no volatility in it. So even for as a trading market, it's not really the best type of market. So I'm trying to have my sort of semi-macro approach, or macro light, whatever you want to call it, and I will see if I find the way in cheaper charts, find like 1 or 2 pairs that you can just trade a little bit to, pass boredom or something.
One thing I do know is, if you want to try and make sense of macro, stick around on LinkedIn. Both Pete and myself always are quite vocal, and we share a lot of, I'm a bit of a poacher myself. I like to look at stories, share, comment on, comment my so-called wisdom on other people's feeds, and I get various likes, and I get some there's not a dislike on LinkedIn, but
Yeah,
I certainly get
luckily.
I certainly get comments, but that's all good. We encourage disruptive but polite conversations, and it's great. I mean, one thing I will mention, it's been a great session. It's been US centric, special edition. It all kind of, we'll see something on Tuesday, hopefully, but it all kind of boils down to the Fed, I think, and data. And, if we get a really good bit of hard data, then, buy the dollar. There's nothing, because rates will follow suit. And, if we're in this world where we are pragmatic, maybe the market will not want to risk so much and grow up a bit.
What do we have? We have
get a bit more.
We have Powell speak on Tuesday.
All right.
Let's see. And he speaks, let me just get you the time. London, there we are. So we have Powell's speech on Tuesday at 10:30 p.m. GMT. So in our late evening, we have it doesn't say. Actually, sorry, wait a minute. Powell speaks 17:45 GMT. Sorry, and then George, the biggest hawk. It's a she, actually, even though that I thought all my life it's a he. It's a she. Who has gone from the biggest hawk on the cheat sheet to the dovish camp, if you remember her speaking for the Fed meeting, right? So I think that's what we said in the beginning from our session. We got to watch the Fed speakers, whether there's some fine-tuning coming, whether there's further explanations coming, and having George as the biggest hawk or former hawk, and obviously Chairman Powell speak on Tuesday, could be. And then an hour later is actually FMC member Messer speak as well. So Tuesday we have, and then George speaks again past midnight into Wednesday, middle of the night. So we have quite, so Tuesday to Wednesday, it's a lot. Then Wednesday afternoon we have Bostich and Messer again. So next week is full of Fed speakers. So that might be very interesting in terms of what we just discussed, to actually see, what are they saying? Are they fine-tuning? Are they explaining? Are they sticking to it? What do they say? So it could be a big week in terms of Fed speaker. I'm always very interested in the Fed speakers, especially after a Fed meeting, and especially after the one we had now, which was really such a big surprise. So it's going to be interesting.
Well, look, that is a perfect segue into if you want to navigate Fed speakers, because we've got an expert here on the show. We don't get people that aren't knowledgeable about macro and Fed speak, and who better to give you amazing commentary around the Fed speakers on Tuesday. Well, you mate, the ball is in your court, mate. Tell our viewers what you can do for them.
Yeah, so basically what I do is I do the main sort of charts in the morning, 4-hourly and daily charts, or something for the day traders, something for the macro guys. I give my sort of spin to it, my IDs, my position, trade IDs, and I comment. I write a piece called My 2 Cents, which I'm trying to sort of just give you a little bit of insight in my thinking. And it's basically the sort of work what we try to do to break macro down into a tradable trade, as I sort of call it, macro light, because that's probably what we need most in trading, is a sort of the real essence of how the stories are shifting and adjusting. So if someone is interested in my work, ping me directly or ping Patrick, and we can have a chat about it, and you can have a look at what I do.
Fantastic. That's great. Thanks, Pete. And like I say, we'll both be pretty vocal on LinkedIn all week. That's it. That's the show, done and dusted. Just be careful of that risk. And I said this, I think, 2 weeks ago, but this is Eureka Hedge, data, there are 11,000 hedge funds and 550 closed last year.
Yeah.
So, and some of these guys are ex-NASA scientists. So be easy on yourself. If you have a bad week, cut your size. Just take a step back. We've all had it. Don't be a hero. You know, there's a lot of very, very smart people out there losing a lot of money. You know, trading's very difficult. So just try and enjoy it, because it's the best job in the world. All right.
It is.
That's it for now. Thanks, B. All right, really good session.
Thanks, Patrick, for having
We'll
me.
be in touch. Take care.
Take care. Night, night. See you. Bye.